This is task 10 from Personal Tax Sample Assessment 2. This task is about inheritance tax. So in part A, we need to identify whether the following statements are true or false. So the first one, transfers of assets between spouses or civil partners are potentially taxable for inheritance tax. Well, this is false. Transfers between spouses are exempt from inheritance tax. So it's allowed for our husbands and wives and civil partners to inherit from us without having to pay inheritance tax. Secondly then, a gift of £2,000 from an uncle to his niece on the occasion of her marriage would always be exempt from inheritance tax. Well, let's look at the reference material to help us with this. So section 16 is about the various bands, and then we've got in tapering relief, and then section 18 is about exemptions. So for on the event of a marriage, so there are some exemptions, but if we look at the list, we've got parents, grandparents, one party to the other, so from the husband to the wife or wife to husband say, but for others, so that would include uncles, we've got a £1,000 exemption. So in this case, we have a gift of £2,000, so that means that would not be exempt, so that's false. Statement 3, limited companies are not treated as chargeable persons for inheritance tax purposes. Yeah, that's true. Companies cannot die. So yeah, we don't really worry about inheritance tax for companies. Then statement 4, every year Mrs. H gives £200 to each of her grandchildren for their birthdays. These gifts will be treated as exempt transfers for inheritance tax purposes. So here are the reference materials, and it tells us that for small gifts there is an allowance of, or an exemption of £250 per transferee, that's per recipient. So yes, the inheritance tax isn't supposed to tax people just giving birthday presents, so as long as it's not too much, then that's okay. So in this case, we have a £200 birthday present, that's less than £250, so that's true. Yeah, this would be exempt. And then the last statement, inheritance tax payable is calculated depending on the income tax rate of the deceased. So no, it's not. So it's simply 40%, but if we give a sizable amount to charity, then we'd get a 10% discount. So the amount payable depends on the value of the estate and whether or not we donate to charity as part of our inheritance. Let's move on to part B. So complete the following statements that relate to inheritance tax. So a potentially exempt transfer is only chargeable to inheritance tax if the transferor dies within, well, the answer here is 7 years. Okay, let's have a look at the reference materials. So we can see 7 years in the reference materials under section 17. So the idea of this potentially exempt transfer is that if we know we're going to be dying, potentially we could give away lots of our stuff before we die to avoid having to pay inheritance tax. So the tax rules recognize that. So if you give something to somebody shortly before you die, then the government will look at that transfer and try to decide, well, was this like a genuine gift, or was it you trying to avoid inheritance tax? And so what it's going to do then, it will just assume that any gift in the 7 years prior to your death is you trying to pay less tax. But it will recognize that if you did give the gift a long time ago, then perhaps you won't have to pay so much tax on it. So we can see there in the tapering relief, if we gave a gift more than 6 years ago but less than 7 years ago, then there'd be an 80% reduction in how we calculate the inheritance tax. Whereas if we give a gift no more than 3 years before we die, then there's no reduction at all and the full inheritance tax would be paid on that. Now remember that some gifts, for example, if we were going to make a gift to a trust, then that would be chargeable and there's no 7-year rule for that. So let's look at the next statement. So where a person does not use all of their annual exemption in a tax year, the unused excess can be, well, it can be carried forward, by 1 year. So there's a 3,000 exemption. So if we don't use it this year, then we can use it next year as well as next year. So it could be that we have a 6,000 exemption next year, but it can only be carried forward 1 year. And then for part C, Miss M lives in the UK and made only 3 gifts during her lifetime. So we need to complete the table to show whether these are exempt transfers or potentially exempt transfers. So yeah, there's going to be no transfers to trusts here, so none of them were chargeable lifetime transfers. So on the 30th of May 2018, she made a gift to a national political party. Okay, so for political donations, that would be an exempt transfer. And then the second one, there was a gift to her daughter on her wedding. So we know that if there is a marriage, then there can be an exempt amount. So from a parent to a daughter, 5,000 of that would be exempt. But the gift in this case was £20,000, which means that the rest of it would be potentially exempt. And then on the 1st of November, there's a gift of a painting to a local museum. So that local museum is likely to have some sort of charitable status, so that would be an exempt transfer.